The real estate market is mixed right now. On the one hand, residential real estate is, it's actually doing pretty well. And at the moment, it's partially responsible for keeping the economy, standing on its own 2 feet. And that's great. On the other hand, new housing starts and new residential sales are down. The interest rate on the 30-year fixed rate mortgages is up like 69 basis points since February 28th, the start of the war. And that is slowly closing the door on new mortgage originations, which is down about 13% in the first quarter of 2026. Now, having said that, let's back up and look at the broad market. First, we'll look at the Shiller National Home Price Index. This is the Shiller National Home Price Index. As you can see, it's up about 1.22%. That's not a lot, but it's positive. Next, we'll look at the Federal Reserve's National Home Price Index. This is the Federal Reserve's National Home Price Index. It's up about 3.33% over the last year. Again, that's great. In the general economy, 8 of the leading economic indicators are pointing down right now. So having the residential real estate market, being relatively strong is a big deal. Next, we'll look at the regional markets. The weakest region in the country at the moment is the Northwest. Now, Portland is flat, but Seattle is down. The strongest region in the country right now is the Northeast, with Boston being up 2.6%. But first, let's look at Seattle. If you're looking to buy or sell commercial real estate, or if you're looking to buy or sell a business, if you need help pricing those assets, go to our description box below this video and hit the more. You'll find 2 videos from our continuing education courses on how to both price commercial property and rental properties, and how to price a business for either purchase or sale. I think you'll find these educational videos of help. Having said that, if you need help, feel free to reach out. There's no cost or obligation. Seattle is down 1.74% in the trailing 12 months. But it's been, oscillating in, a pretty narrow trading range. So all in all, it's not that bad. Next, we'll look at Boston. Boston is up 2.6%. What's impressive here is the trend line. Chicago and New York have very similar trend lines, and all of that's trending up. And again, that's really impressive right now. Next, I want to look at interest rates and what effect that might have moving forward. As I mentioned at the onset, interest rates have jumped up about 69 basis points just in the last 5 months. Let's look at that. As you can see, mortgage interest rates have been trading between 6 and 7% for the last 3 years. But again, in the last 5 months, they've been on the rise. Well, what's going on with interest rates? Well, to help answer that question, one key data point is the Producer Price Index. This is the Producer Price Index. They've really jumped up this year. Producer prices are prices or costs upstream of consumer spending. And as you can see, they're up over 10% in the last 12 months. You couple that with the war in Iran and the prolonged closure of both the Strait of Hormuz and the Strait of Mandeb, we've got some inflationary pressures coming at us from multiple directions. Now, having said that, I want to jump to commercial real estate and what that means for commercial real estate. But first, I want to look at cap rate spreads. But before I do, I want to explain what a cap rate spread is in simple terms. Cap rates are the effective rate of return on real estate. Now, having said that, given real estate carries more risk than, let's say, a 10-year U.S. Treasury, it would make common sense that commercial real estate would carry a higher interest rate or rate of return than, let's say, a U.S. Treasury. That makes sense, right? Well, given that, Historically, commercial real estate carries about a 342 basis point or 3.42% higher rate of return than a 10-year U.S. Treasury. Now, having said all that, let's look at the cap rate spread. Well, there's a lot going on here, but to keep it as simple as I can, the black line right here is the average cap rate. And the green line right below that, right here, is the 10-year U.S. Treasury. And as you would expect, the black line or the cap rate is historically about 3.5% higher or above the 10-year Treasury. Again, the graph might be a bit complicated, but the concept is pretty simple. You simply expect a higher rate of return from real estate than from a U.S. Treasury. The point being is this: interest rates are going up. And with that being said, so are cap rates. Here's the last point I want to make. A 0.5% increase in interest rates or mortgage interest rates and a 0.5% increase in the cap rate will automatically drop commercial real estate values a little over 10%. It's just simple math. Now, that being said, expect prices of commercial real estate to come under pressure in the months ahead. Again, if cap rates decompress, or i.e. go up, even 0.5%, expect commercial real estate prices to drop about 10% in value. That's something to keep an eye on. Until next month. Real estate brokers. How do you stay current with your clients who may not be buying or selling a property, for the next year or two? If you're not careful, they won't even remember your name a year from now. The question is, how do you stay relevant? I get it. I've been at this a long time, and it can be tough knowing what, if anything, to say when you call them, 6 months to a year from now. To solve that problem, I have for years kept in front of my clients by sending them an economic newsletter periodically. Today, we do that with simple 5 to 7 minute videos attached to an email. I've worked with some clients for well over 20 years, using the economy as a common denominator and point of communication. And I can tell you from personal experience, it works. In that process, if I can be of help, feel free to reach out to me. What I have found is if you do this, you'll come across as knowledgeable, experienced, and hopefully competent. And at the very least, they'll remember your name.